One of the biggest mistakes that home buyers make is thinking that they need a 20% down payment in order to buy a house, and that's actually not true at all. In fact, there are several different loan programs out there that can help you get into a house with very little to zero money down. But if you don't know what these loan programs are or which ones might be the best fit for you and your family, you could be leaving thousands of dollars on the table. So in this video today, I'm going to be talking about the top 4 loan products out there that people typically use when they are buying a house. I'm going to be covering some of the pros and cons that are associated with each of these as well. You're going to want to stick around for the last loan product that we talk about because it is one that I see is often overlooked and has some really great benefits. So please stick around to the end so you can see that loan type and learn a little bit more about it before you consider using any of these others that we're going into. But let's go ahead and dive on in. But before we get to all the fun, juicy details here, if we have not met yet, my name is Brock and I help folks just like you buy and sell homes here in San Antonio and the surrounding areas. So if you are thinking about moving to San Antonio or if you're looking to buy a house here in the San Antonio area, please do not hesitate to reach out to me. I've got all of my contact information down below, and I would love to be a resource for you and more importantly, help you and your family find that perfect house. All right, so first up is probably one of the more popular loan types out there that I see people using, and that's going to be the FHA loan. Now, a lot of people get this misconception and think that FHA stands for first-time home buyers, but FHA actually stands for the Federal Housing Authority, which is actually the government agency that actually insures all of these loan products out there for you guys. But the FHA loan is designed for first-time home buyers as it has some flexibility with the requirements and everything. So let's dive into those requirements right now. First off, with the FHA loan, you do not need to have a perfect credit score. So if you have a credit score of at least 580 with the FHA loan, you can actually get a down payment of 3.5%, which can save you thousands of dollars just on the closing cost expense alone. Now, if you don't have a 580 or better, the FHA actually allows you to go down to a 500 credit score as the bare minimum, but with a 500 to a 579 credit score, you will be required to have a 10% down payment. So it is significantly more out of pocket for the down payment, but you can still buy a house with less than 20% down and not so great credit. Of course, if you want some of the best terms on the interest rates and stuff, the higher your credit score, the better off you're going to be. Now, another thing that these lenders will look at when you apply for a loan is going to be what is called your debt to income ratio, or your DTI. Now, with an FHA loan, you can have a DTI of 43%. And before we get too much further into it, of course, again, your DTI is your debt to income ratio. So what they do is they look at all of your debts. So it could be your student loans, car loans, other mortgages you have, any credit cards, any other debts that you may have out there, whether it's child support, alimony, anything like that as well. And they're also going to take a look at all of your income from all of your income sources out there. Now with the FHA, they do have some stricter requirements on the condition of the home. So it needs to be in a safe, livable condition. So you have to have a roof and a foundation that is in good working order. You also need to have plumbing, HVAC, and electrical that are all in working and safe conditions as well. So working with a knowledgeable agent will be able to help you identify some potential problems in case you're looking at some properties that may not meet all of the livability concerns, but you can negotiate these with sellers in a lot of the cases to get a lot of these issues corrected before you become the owner of the house and obviously satisfy that requirement for the FHA. Now, the biggest downside to the FHA loan is going to be what is called mortgage insurance premium, or MIP. Now with the FHA loan, if you're putting less than 20% down on the house, you will be having to pay this mortgage insurance premium, and you're going to be paying it in 2 different ways. The first way is you're going to be paying an upfront one-time cost at closing. This is 1.75% of the loan amount. So if your loan amount is going to be $300,000, then whatever 1.75% of that $300,000 is what's going to be that upfront mortgage insurance premium cost to you guys. Now, outside of this one-time cost, you will have an annual mortgage insurance premium to pay, and this is collected every single month as you pay your mortgage. So whenever you do make your mortgage payment, part of that payment is going to be that mortgage insurance premium that's going to be held in escrow for you, and then whoever services your loan will go ahead and pay that on an annual basis for you so that you are compliant and making that payment. Now, with this mortgage insurance premium, it is for the entire life of the loan. So as long as you keep this loan, you will have a mortgage insurance premium no matter if you owe $300,000 that you got at the beginning or if you owe $10,000 remaining after several years have passed. You will still have this mortgage insurance premium unless you go ahead and refinance your home. So it could be in your best interest at some point in the future of using a FHA loan to refinance the house and get that MIP taken out of your payment. All right, now the next loan type is going to be the conventional loan. Now this one is a little bit less forgiving in some areas than the FHA loan, but it might be more strict in other ways. So let's go ahead and dive into some of these details on the conventional loan. Now with these conventional loans, you can actually get away with a 3 to 5% down payment is what I'm seeing in most cases. But of course, if you have a 20% down payment, you're going to avoid PMI, which is private mortgage insurance. And it's very similar to the MIP that we talked about in the FHA loans. They're the same thing, just called different things for the different loan types here. So if you want to avoid a PMI, of course, put at least 20% down. And with at least 20% 20% down, you can actually buy these properties as investment properties right off the bat and use them for that with this conventional loan. Now, if you're putting less than 20% down, usually the rule is, of course, that you use it as a primary residence for a little while, and then you could turn it into a rental property in the future down the road there. Now, let's go back to the PMI for just a second real quick. On the FHA loans, we talked about how the MIP was for the entire life of the loan, unless, of course, you refinanced it. With the conventional loan, you can actually cancel the PMI once you receive at least 20% equity in the house. So you can actually get rid of that payment without having to refinance it. Of course, you're going to have to pay down that loan balance, and so it might take a few years, but there at least is a light at the end of the tunnel for you to get rid of that extra payment of the PMI there. Now, going on to some of the requirements for a conventional loan, most lenders like to see at least a 620 credit score or better for you to even qualify for it. So if you have less than a 620 credit score, a conventional loan may not be the best option for you. So if you have at least a 620 credit score, you can get away with a slightly lower down payment requirement down to 3% and use the conventional loan here. Now, if you have a higher debt to income ratio, the conventional loan is a little bit more forgiving in this area, as you can have up to a 45% debt to income ratio, so a little bit higher than what we saw on the FHA, and that can actually make a big difference depending on what you have. Of course, the lower your debt to income ratio, the better you're going to be across the board, no matter the loan type you're using. Also, with conventional loans, they're not very strict on property conditions, so they're a little less demanding on the safety aspects of it. You can use this to buy a house that needs a little bit more work or a little bit of updating. Maybe there's some stuff that you can do that aren't a major safety issue, but of course need to get done. For instance, I personally purchased a house that had some foundation issues with a conventional loan in the past, and I did this because of that reason of the flexibility on it. So of course the foundation wasn't a massive problem on this particular house that I personally purchased, but the conventional loan was more flexible and allowed me to buy that property and then get the foundation fixed without having to negotiate that and get it done upfront. Now, the next loan type I'm going to cover is going to be my absolute favorite loan product out there to use, and if you are eligible to use it, you shouldn't be using any other loan out there, and unfortunately not everyone's going to qualify for it. And what I'm talking about here is the VA home loan. And the VA home loan, of course, is only for those who are active duty service members, and there are a few other ways to qualify for the VA home loan there, but being an active duty or a veteran typically is going to get you there no matter what. Now, with the VA loan, it is going to be the most powerful wealth building tool. So if you do have access to the VA loan, again, you shouldn't really be looking at any other loan product, in my opinion, unless there is a certain situation that arises where maybe another loan product is the better option there. So with the VA home loan, there is no down payment requirement. So you can have a zero down payment requirement whenever you go to purchase a house. There is no PMI, which is saving you a couple $100 every single month because you don't have this PMI. They also have some of the lowest interest rates out there compared to conventional and FHA, and FHA rates are only usually a little bit higher than VA home loan rates, so not significantly higher, but VA home loans typically have the lowest interest rate among all of the loan products out there. Now, to qualify for the VA home loan, again, outside of being active duty service member or a veteran, you do have a few other qualification requirements. If you are active duty, National Guard, or reserves, you do have to have at least 90 consecutive days of active duty service outside of basic training and your job training. So think of AIT or tech school or whatever it may be called in some of the other branches out there, but you have to have 90 days of active duty service after that event there. So typically you need a TDY or deployment in order to be eligible, or again, just 90 days at your first duty station if you're active duty. But if you are National Guard or reserves and you do not have the 90 consecutive days of active duty service after tech school or AIT or your job training there, you will be eligible for the VA home loan after 6 years of service in the Guard or reserves. Now, the VA home loan does not have a minimum credit score requirement, which is another huge advantage to the VA home loan. Now, with this, of course, if you have at least a 620 or better on your credit score, you're going to get the better terms on your interest rate and your loan and get a little bit lower overpayment than someone with a lower credit score there. And outside of this, also, there is no DTI or debt to income ratio requirement. Again, the lower you keep your debt to income ratio, the better off you're going to be and the better chances of being approved for that. I have seen and heard of some lenders going up to like 55 and 60% debt to income ratio, but again, don't risk it. If you can lower your debts and increase your income at all, that will help you be in a better position overall and have a better chance of being approved for a VA home loan. Now, with the VA home loan, there are some stricter requirements on the condition of the home, very similar to the FHA rule. So there needs to be some minimum safety and health standards that the house meets. So there can't be any major issues with any of the major components on the house. It has to be in a safe, livable condition as well. Now, again, if you do happen to find a house that has some of these safety issues, you can negotiate with the seller and try to get them to fix them before you buy the property. But if you're going to look at a house and you see some major safety issues and the seller's not willing to fix those, and you know that upfront, maybe it's not the house for you guys to pursue, but you could always try, and it's always good to, keep those things things in mind whenever you're looking at these houses. And as a side note, one of the other benefits of the VA home loan is the fact that it can be used over and over again, and you can actually have multiple VA home loans at the same time. So if you are active duty and you purchase a house at your current duty station and then you get orders to PCS to another duty station, you can actually keep your house at your current duty station and use the VA home loan again to purchase a second house at your new duty station. So there is some really good ways to build some wealth using the VA home loan, especially knowing that you're going to be PCSing from base to base in the future. And of course, there are some things you have to keep in mind with that, but I'm not going to get into details here. I'll make another video explaining the VA home loan and some of these other loan products in greater detail so that you have a really good understanding of all the benefits and all of the drawbacks from these home loans out there. Now, the final loan product that we're going to discuss today is actually one that is often overlooked and could be a really big advantage to a number of people out there if you're trying to buy a house. And here in San Antonio, it is actually very usable, especially among the new construction homes in the area, and people just often overlook this loan. Now, the loan I'm talking about here is the USDA home loan. Now, the USDA home loan is one that is actually backed by the US Department of Agriculture, and it's designed to help people buy homes in rural locations, so locations that are often outside of city limits. And so if you're trying to buy a house in the middle of a city, of course, this loan isn't going to qualify because the property has to be in a specific area. But let me share my screen with you. You can see here a map of the United States. If you just search the USDA property eligibility map, you will eventually come to this right here. And you can see all of these areas that are in this yellowish color are areas that homes are not eligible to buy a house with the USDA home loan. Now you can see all of this other white space leaves a ton of opportunity for homes all across the United States that you can buy a house with your USDA home loan. But let me zoom in on San Antonio specifically. Let me zoom in here. And you can see right here, all of this in the San Antonio area, all these little yellow areas. Of course, again, you cannot use a USDA home loan to secure a property here. But in this area right here that I'm kind of outlining with my mouse on the east side of San Antonio, as well as this area on the west side of San Antonio, there are hundreds of homes out here that are being built and already built that would qualify for the VA home loan. Now, of course, on here, you can actually enter a specific address and see if it is eligible by there. But for the most part, there is a lot of homes out there that can actually be purchased with the USDA home loan. So that is one of the requirements. Of course, the property has to be eligible outside of you being eligible to use a USDA loan. Now let's talk about the requirements for you to secure a USDA loan. One of these requirements, of course, is going to be an income limit. So you can't make too much money in order to use a USDA loan. And what they say is if you're using one of the guaranteed loans, your household income cannot exceed 115% of the median area household income. So for 2025, the standard income limits for most of the United States was about $119,850. So if your household income exceeds that, unfortunately, you are not eligible for the USDA loan. But if your household makes less than that, then you would be considered eligible for a USDA home loan. Now, when it comes to your credit score here with a USDA loan, you do need to have at least a 640 or better to get a guaranteed USDA home loan. Whereas if you're getting a USDA direct home loan, there is no minimum credit score requirements. And a USDA guaranteed loan is one that is done through a third-party mortgage provider, whereas the direct USDA home loan is directly from the USDA. So if you know your credit score is at least a 640 or better, you can use any lender out there you would like. But if you have if your credit score is below 640, you're gonna have to go work with the USDA directly in order to get that home loan. Now with the USDA home loan, there are a couple advantages here that mirror the VA home loan. So if you're looking to use a USDA home loan, you actually have no down payment requirement, which could save you thousands of dollars in closing costs. On top of that, there's also no PMI or private mortgage insurance payment that you have to make. So with the USDA loan, you can get into a house with no down payment and you do not have to worry about paying a PMI as well. All right, well, that is all I wanted to share with you guys on these 4 different loan products out here. Again, these are the 4 most common loan types that people use to buy homes, at least here in the San Antonio area. There are a lot of different other loan products out there for different scenarios and situations that might be more advantageous for you. So please don't take this as these are the only 4 you can ever use, because there are a lot of them out there. I know lenders with probably hundreds of different loan types out there that you can use for various scenarios. So if you happen to have any questions about any of these loans, buying a house, or living in San Antonio, or anything else I can help you with, please do not hesitate to drop a comment down below or reach out to me directly. I've got all my contact information down below. And again, I would love to be a resource for you. I would love to help answer any questions you have, and more importantly, help you and your family find that house that you've been looking for. So with that, thank you one last time for watching this video. If you haven't already, please go ahead and give me a like on this video if you found it useful. And while you're there, don't forget to hit that subscribe button and tap the bell icon on so that you'll be the first to know the very next time I post a video. I'm here to make videos about living in San Antonio, buying a house, and buying new construction homes, and everything in between. So with that, thank you one last time. I hope you guys have an incredible day, and I can't wait to talk to you guys here soon.